With increased environmental volatility across the globe and with climate change dominating headlines, there's an ever-increasing need for insurance. As this demand grows, Securis Investment Partners has become a distinctive and disruptive force in insurance-linked securities and have found themselves well-positioned to ride out recent storms.
Natural disasters can be devastating. When Hurricane Andrew hit Florida in 1992, it was one of the most destructive and costliest, causing over $15 billion in insurance losses at the time. To make matters worse, there was a shortage of insurance cover. This is when the first catastrophe bond was issued and insurance-linked securities was born, a system that allows insurance companies to transfer risk to the capital markets.
Typically, the type of risk that you assume is exposure to, for example, a natural catastrophe. Okay. Now, this is a kind of a low frequency but fairly high severity type event, whereby it doesn't happen very often. It has a low probability of happening. But when it doesn't happen, you'll still collect your premiums. Okay. So over time, the premiums that you collect should outweigh the losses that you pay.
Keeping an eye on the eye of the storm is Dr. Paul Wilson. He works as a scientist at Securis, a London-based asset management company. It invests exclusively in ILS. He has a PhD in atmospheric science, has visited disaster zones and developed models to understand the risks of major catastrophes.
There is nothing more exciting than coming into work in the morning knowing that you have to help people understand the impact of a natural catastrophe which is occurring and can be unfolding as the day goes on.
There are catastrophe models to help assess risks, such as how buildings will hold up in a potential hurricane. But Paul and his team also analyse the potential impact of climate change.
When you layer on top an environment which is changing and sort of the implications of climate change and how that is impacting on natural catastrophes, to ensure that we are pricing all of our investments accurately, you do need to have that sort of in-house expertise in not only how these models will be built, but also their limitations.
Investments are mostly natural catastrophes, but also include life insurance and health-related risks. Investments are kept separate from the turmoil of capital markets.
We want to give investors an exposure to pure insurance risk, so not linked to credit or capital, equity markets, but rather to the actual risk taken by the insurance company.
This has allowed the ILS market to weather various financial crises. Of course, one of the biggest impacts recently was the COVID-19 pandemic, causing economic turmoil. Governments across the world stepped in to help, but it was worrying times for investors.
The markets tried to correct themselves in March of 2020 when the world realized that we're actually at the beginning of a pandemic. But then a kind of a spectacular amount of monetary intervention from governments ensued, and the markets recovered. But nevertheless, the markets were down 20-25% in March, during a period where insurance-linked securities was largely unaffected.
Securis manages around $4.5 billion of assets.
So the ILS market has grown from around about $11 billion in 2005 when Securis was formed to $100 billion today. The types of opportunities within the market has grown quite considerably as well. Back in 2005, a large focus on remote risk cat bonds, fairly vanilla structures, but today a much wider variety of structures, more complex, a wider range of return profiles as well.
Top tier consultants have been suggesting pension funds for quite a while to have at least between a 2 and a 5% allocation of their assets to ILS, precisely because of the decorrelating nature, alongside a quite interesting and attractive return.
And other insurance risks are now being considered.
Beyond natural catastrophe, other insurance-related risks could include space, aviation, marine-based risks, risks related to other sort of property exposures like fire, terrorism, for example. And all of these risks are being looked at very, very closely by the ILS market.
70% of economic damage caused by natural disasters around the world go uninsured. The ILS market can help close this gap.
Insurance allows people to rebuild their lives when bad things have happened. So that is a pretty good starting point when we start discussing ESG with investors and our stakeholders.
Big natural disasters don't occur that often, but when they do, there's a huge amount to learn.